Hello, everybody. This is Colin Murphy, and welcome to Torcana podcast number 30. And now, for the first time in a while, I've got a guest on the show. I'm very excited to have him on. His name is Keith Weinhold. A lot of you might be very familiar with him. He's the owner of GetRichEducation.com, which is a terrific resource about real estate investing. He's the host of the very popular Get Rich Education podcast, which I had the honor of being a guest on. I believe it was episode 214. He's a writer for Forbes magazine. He's an international best-selling author, and he's an active property investor. I believe he's been active for at least the last 15 years. I know he owns apartments in Alaska. He owns investment properties in Texas and Florida. I believe he has some investments in South America as well. So this is a very, very interesting guy who's got a lot to talk about with regards to real estate, and he's an expert in helping people learn about real estate. And I know a lot of people I deal with that buy from me here in Tampa, Florida, speak extremely highly of Keith. I've met Keith couple of times, and he's a terrific guy. I'm delighted to have him on the show. Hey Keith, welcome to the show. How you doing?
Colin, great. Thanks so much for having me here. It's an honor.
Oh, no, it's our honor. Thanks for coming on. So, look, a lot of our listeners will definitely have heard from you, Keith, but for those who haven't, tell us a bit about yourself and how you got into real estate investing.
Yeah, well, I think you learned a bit about me in the bio there. The way I got started is I bought a fourplex building in Midtown Anchorage, Alaska for $295,000 back in 2002. So now let's take a step back to see how I got there. You know, I was raised with two great parents that are still happy. They're still together. I came from a lower middle class upbringing in Appalachia, upstate Pennsylvania. But, you know, my parents did instill, travel well. We're clipping coupons for Raisin Bran here at home, but travel well. Get out and, find out about who you are and find out about, don't live to get paid to live, and think aspirationally. It's something that my father instilled in me, especially even though he didn't have any real estate or entrepreneurship background. So when I graduated from college and kind of came of age, Colin, one place that we had traveled was Alaska. In fact, I had made 4 vacations to Alaska, just using airline miles and just barely scrimping by to visit Alaska. And I dreamed of living in Anchorage, Alaska, because that fit my interests for skiing and mountaineering.
Oh,
So more than 15 years ago, I made the move after college from Pennsylvania to Anchorage, Alaska. And shortly after I moved to Anchorage, I was just renting an apartment, and I fell into a crowd of what I would call aspirational friends, Colin. You've
mm-hmm.
probably heard the famous Jim Rohn quote, "You are the average of the 5 people that you spend the most time with." 2 of my 5 closest friends had made their first ever home a fourplex building where they lived in one unit and rented out the other 3. So doing this and starting this way myself, even though I had only been a rent-paying tenant until I bought this building in 2002, just didn't seem that scary or didn't seem that abnormal or
Mm-hmm.
out of whack, because I had a couple friends that were doing the same thing. So I knew it was a pretty big deal when I bought this Midtown Anchorage fourplex for 295K. And you know what, Colin? This says a lot about sometimes how in life it's best to start before you're ready. When
Yep.
I bought that building, I did not even know what the term cash flow meant. I
You're
didn't
probably
even
pretty young, right? In your 20s, early 20s?
Yeah, I was. And I didn't even know what the term equity meant. Basically, all I knew is my friends were basically living for free because the rent income from the other 3 tenants met all the building expenses. So that's how I
Mm-hmm.
started with a bang, with just a 3.5% down payment on an FHA loan. That's the greatest and biggest building you can get, with a 3.5%
Mm.
down payment. So that's how I began, with a bang.
Great. It's a great start. Great to start when you're young. I couldn't agree more. And look, we all know that the economy has been booming recently. The stock market is still doing really well. Companies are doing great, but you still notice a lot of people are still struggling financially. A lot of people are still not, they don't have enough money to do what they want to do to achieve their goals and move up the ladder. I mean, why do you think so many people still struggle financially in today's economy?
Yeah, I think when people think about money and their own personal economy, the word problem soon comes in afterward, and they think about money as
Mm-hmm.
a limiting factor. And really, Colin, I think the reason, just kind of conceptually here, before we get more nuts and bolts later, the reason that people struggle financially is they're not thinking big. you can just generally stratify society into poor, middle class, and wealthy. Poor
Hmm.
people don't have any money left over from their paycheck to invest. Middle class people, they do typically have some money left over to invest from their paycheck. And here's the thing, middle class people think, how could I best get my money to work for me? Well, I'm here to tell you, you need to stop thinking that way. Because if you're going to live a great life and try to achieve financial freedom, stop getting your money to work for you. Stop focusing on that. Instead, you need to take a page out of the wealthy playbook. As an everyday person, you can ethically employ other people's money. That's the paradigm shift. And actually, with something like real estate investing, you know this, Colin,
Hmm.
you can employ other people's money three ways simultaneously, even if you're a middle class everyday person and you don't need any degree and you don't need any certification. And that's when you do something like invest in cash flowing real estate. How do you use other people's money three ways at the same time? First of all, use the bank's money for
Hmm.
leverage and a loan. Just take it back to the fourplex example. I made a 3.5% down payment. The bank made a 96.5% loan to me, but any appreciation on the property, the 3.5 or the 96.5, all goes to me. The second of three ways of using other people's money is you're using the tenant's money for the cash flow, that passive income stream. And the third way is using the government's money at scale for very generous tax incentives, like a 1031 tax deferred exchange, which means you legally never need to pay capital gains tax on your real estate. I never have. And something called tax depreciation, which means a portion of your rent income
Hmm.
is completely sheltered from taxes. So it's the mindset shift going from middle class to wealthy by not just getting your money to work for you, but getting other people's money to work for you. And you're doing that three ways at the same time with passive real estate investing: the banks, the tenants, and the governments.
No, I love the way you explain that. I totally agree with it, and I've never quite thought of it that way. The three ways I've clearly kind of borrowed money to invest before, and I've kind of known the
Yeah.
benefits. But the way you explain it is very clear and just makes me want to scale up even faster than I am. So, I'm a very optimistic person. I always have been. I love just diving into things and getting stuck in and doing things. But if I was a pessimistic person, I might say, it's coming into 2019 now. The market's been appreciating for 7 or 8 years. I wish I had have invested back in 2010, 2011. I've missed the boat. It's too late to invest in real estate now. I mean, I don't agree with that. I mean, what do you think? Is today a good time to be an investor?
Is today a good time to be a real estate investor? Very germane question. Prices have run up, and now interest rates have gotten into the act, and they began running up about
Hmm.
2 years ago. Really, my thought is, if you're not going to invest in real estate, where else are you going to invest and get good returns? Now, I would agree that in general, it was a better time to be a real estate investor 5 years ago than it was today. But today is still a great time to be a real estate investor, I think, for three reasons. I kind of classify them, Colin, into demographic,
Hmm.
geographic, and psychographic. First of all, 30-year mortgage interest rates are still historically low. They were as high as 18% back in the early 80s. Now, Freddie Mac only began tracking mortgage interest rates in 1971. There's no reliable data before that. That comes as a surprise to some people.
Yeah.
And the average 30-year fixed mortgage rate during that entire time is 7.7%. Now that's on a primary residence. So for a rental, it might be more like 8.5%. We
Yeah.
can still get interest rates substantially lower than that today. You're still locking in long-term, cheap, fixed interest rate debt, no matter what prices do. More millennials are entering prime renter age at almost 80 million. They're the largest generation, surpassing the baby boomers. So it really
Hmm.
makes a lot of sense to track at what millennials do. Well, what's been a great part of the millennial experience? Well, college costs are rising faster than inflation, and that means millennials are saddled with student loan debt. So they have a difficult time forming a housing down payment, and that means a greater proportion need to rent. That's something that's really good for us demographically. And there's another larger demographic reason reason across all cohorts. And, so many people overlook this, Colin. I think it's easy to, as an American. It's just that the overall population of the United States continues to increase at more than 2 million people per year, in fact.
Hmm.
Well, that just drives the economics 101 of supply versus demand. Demand continues to increase. And as we know in Florida, where you are,
Yep.
population is growing at more than twice this average. But just nationally, you might take it for granted, but population losses in places like Japan and Greece and Spain, that creates excess housing capacity there. So a lot of these trends, that's resulted in the US now having one of the lowest home ownership rates since 1965. And what that really means is fewer people buying homes. That equates to more people in the renter pool, and that drives rental demand, and that enriches cash flowing real estate investors. And there are a number of other demographic and geographic reasons as well why the next 10 years are set up terrifically for real estate investors that buy strategically. But I think the last one I want to touch on is what I call a psychographic component. See, years ago, millennials, they often saw their parents lose their home in the mortgage meltdown of 2009. And because that happened in the millennials' formative years, I think some millennials still want to own their home, but just not nearly as many. So some millennials have this negative connotation with home ownership, and that drives rental demand as well. So I'm an enthusiastic real estate investor. I'm still buying today, and the reasons are really demographic, geographic, and psychographic.
No, thank you for sharing that. I agree. You're really swimming with the tide when you have the population growing really fast and the percentage of the population that want to be renters also growing really fast. You couldn't ask for a better mix to be a landlord. And if you can get your
Yeah,
hands on a good price property and a good property manager, just sit back and let the market do the rest for you.
even in a downturn, people are still going to need an affordable place to live. That is
Hmm.
not going to change. People always try to predict the future, and sometimes it's worth doing that. But that right there is one thing that we already know for sure that's still going to be true in 10 years and longer.
Yep, I agree. And look, I think we can both agree that real estate is a terrific way at building up your wealth, long-term wealth. But what we don't talk about very often are threats to those wealth. I mean, how can we make sure we're protecting the wealth that we generate, and how can we avoid the mistakes maybe some people make that decrease their wealth?
Well, when I think about threats to wealth, I think of what people refer to as conventional retirement plans. Let's just take the most common one, a 401k. 401ks emerged in the late 70s and early 80s. In fact, I have interviewed the very founder, the inventor of the 401k. 401ks were originally known as salary reduction plans. Can you believe that? That was their original name. So when they rolled out these plans in the early 80s in mass to employees, Colin, they were called salary reduction plans, but they could not get any participation because
Wonder
basically,
why.
yeah, they're telling you what they are. That's not a very great marketing name to try to foster participation in 401ks. Well, my point is, why don't you consider opting out of a salary reduction plan, which is what a 401k is, and instead flip that around and opt into what I will call a salary increase plan. It has the same or better tax advantages than 401ks. And with something like cash flowing real estate, you increase your salary both in the present day and the short term and the intermediate term and the long term, all the way through to retirement. So why would you sock money away with the hope of getting a benefit later if you can instead invest your money and get a virtual guarantee of a benefit both now and later? Like, do you only want to enjoy your life when you're age 68, or do you want to start enjoying life and giving yourself more options and freedom at age 38 instead? So it really is up to you. 401ks don't get people ahead. That's why we have a retirement crisis today. You asked me about the biggest threats to our wealth.
Hmm.
401ks have five simultaneous drags that a lot of people don't consider. They might see that they're getting an 8 to 10% return, or think that they're getting an 8 to 10% return if they look at the S&P 500 over the long term. But when you adjust that for inflation and emotion and taxes and fees and volatility, you are lucky if you are getting a return as good as zero, as good as break even. Those are the threats to your wealth. So You've got to think differently. If you want to do what you've never done before and have what you've never had before, you need to make decisions that you've never made before. So,
Hmm.
if it's something everyone else is doing in society, Colin, it's probably something that I'm not very interested in doing. I don't want to be ordinary.
Yeah, who wants to be a sheep, right? So, I mean, kind of leading on from that, then, I mean, if you don't want to do what everyone else does, if you want to do what the really successful people are doing, how would you go about doing that? I mean, what are the key habits and traits of successful people? I mean, I liked what you said about you are, the average of the five people you hang around with, but just going further than that, I mean, have you any insights into the habits and traits of really successful people and how some of our listeners might learn from them and imitate some of those?
Yeah, you know what? I actually think that the majority of beginning real estate investors have an awful experience, and even advanced real estate investors can learn from this too. You need to be strategic. In fact, I go as far as saying that the property is only the fourth most important thing in real estate. Now, when you think about real estate investing, often a property comes to mind when you want to
Hmm.
make a new investment, and the property is important. But if you're asking me about a key habit and trait of a successful investor, keep the hierarchy of importance in mind. The most important thing in a real estate investment is you. What do you want this real estate investment to do for you? Are you looking for appreciation or cash flow or tax advantages or a lifestyle investment? You need to keep yourself in mind. And this is what I mean when I say that a lot of people have a bad experience with real estate because they're not strategic. How do most people pick an investment property to buy? They do it rather whimsically and by coincidence. For example, if someone makes a round trip to their workplace each day and they drive by this pretty blue duplex, and they always notice this duplex has been nicely landscaped and it has good shutters on it and fresh
Hmm.
paint, and one day they see a for sale sign on it, well, that investor thinks, well, hey, maybe I'll make an offer on that one. I could manage it myself, and it's always looked pretty, and I know I should diversify out of stock. So well, that person probably isn't being very strategic. It's not really all that likely that you probably live in a market where it's investor advantage and you have a high ratio of rent income to purchase price, or you figure you'll just manage it yourself. Well, wait, step back and think about again, what do you want this property to do for you? You don't want another job. You want to be an investor. So you are the number one thing. The second most important thing in becoming a successful real estate investor and you're looking at getting in is the market. Now, most people buy a property for cash flow, but if you don't have a vibrant market where you're buying a property not just that's tenanted today, but when you buy a property, you have a reasonable expectation that in 18 to 24 months or whatever, when that tenant leaves, there's going to be another rent paying tenant that has a job there. So you want to buy in a diverse economic market. And then the third most important thing, I think, is that team of professionals that you surround yourself with. Your
Hmm.
turnkey provider and your property manager being two of those most important team members. And then, fourthly, and only fourthly, does one begin looking at properties, because the first three things don't align. Number one is you, number two is the market, and number three is the team. Then the property won't work either. So if you can be strategic and be well thought out and think that way, you have just massively increased your chances for success as a real estate investor.
Yeah, I couldn't agree more. I mean, I have a lot of people that buy multiple houses from us every year, and I know that the actual house is the thing they spend the least amount of time on. And like you say,
Yeah,
they think about their own goals. They do a lot of work on us, building the relationship with us, looking at the property manager, analyzing the Tampa market, making sure it's got the right criteria for them. And then once they've done all that, picking the property is actually the easiest part because they're happy with the team, they're happy with the manager, they're happy with the market, they're happy with the characteristics that they've identified in the properties they want. So that's the easy part. And you're right, some people just get onto Zillow and start building spreadsheets out of all these properties that are for sale, and they're missing the point. They're skipping all the background work that will really let them know whether they're going to be very successful or not. So thank you for
exactly,
outlining it
Colin.
that way.
Yeah, I mean, here's a great example, and I'll just be very transparent and open with this. I knew I liked you as a provider. I had even met you and visited your market about a year ago. I know that Torcana provides a good product that gives me cash flow. I had already thought about the market and I had thought about myself. So you, the market, and the team were already aligned for me. And then a couple months ago, you and I got on the phone, and in one phone call, I chose two properties from your website and I bought a couple properties from you myself because I was already aligned with what I wanted, that the Tampa market in the submarkets that you're in are right, and I'm with the right team. That's why I had confidence in just scooping up two properties off one quick phone call with you.
Well, thank you, and you're right, and it was that worked out extremely well, and I think we created some win-win situations there. So yeah, it was great working with you. And look, getting on, you're a really busy guy. I mean, I don't know how I'm a busy guy, but you're more busy than me. You've got your podcast, you got your website, you got your writing, your speaking, your networking, you're managing, and you're building a really nice real estate portfolio. And yet you seem to travel all the time, and you're sending me photographs of you on the top of these beautiful mountains or on a bridge in Venice. I mean, how do you manage your time so effectively? You seem to have a really good lifestyle balance, but you're clearly putting a lot of thought into how you manage your time. You've got all these different boxes and different businesses you're involved in. How do you do it? Share your secret with us.
And I do it all from a remote place, Anchorage, Alaska. I need to make long flights back when I come back here every time. You know, the best real estate investors, they live where they want to live and invest where the numbers make sense. And if you, the listener, have heard that before, live where you want to live and invest where the numbers make sense, then why don't you live where you want to live? I live in Anchorage, Alaska, very intentionally where I want to live because it fits my interests. But yeah, Colin, maybe you're wondering, well, how do I get these things done? I write for Forbes, I write for the Risk Advisors, I write my own blog article, I've written a book, I crank out the podcast every week. We do videos for our YouTube channel, and I run all of those platforms on Get Rich Education. And yeah, I'm a real person just like anyone else. When I have Robert Kiyosaki as a guest on the show, again, I'm a little nervous when he's going to come back. Okay, so
Mhm.
I think a lot of the same things that everyone does, but I think it really comes down to a few things, and it's two parts. Number one, open up your time. And then, of course, number two, how are you filling that time? Well, first of all, I don't work a day job. I had enough passive income from real estate to leave my day job. And it's just incredible all the stuff that can fall off your plate and out of your mind when you don't have a day job anymore. So, maybe it seems like I do have time to be well thought out or live a big life, but I don't have that drag of a job. You desperately need to get freedom in your life. And the way I organize my time, I think it comes down to a couple things. And, you're going to find this one kind of weird, but
Okay.
just hear me out. Okay. This first one, I think I would call it don't text me, bro. And what do I mean when I say don't text me? Texting and instant messaging, that really fractures one's focus time. You
Uh-huh.
might think you block out time, but if you look at your phone on a break, that can take you away. So for example, like I've had a friend that's, texted me, 5 photos from their family vacation.
Hmm.
Now, I care about this friend. I want to look at photos of his vacation, but oftentimes when a text is sent, I think the sender is thinking of what's a convenient way for them to send a text. When I receive a text, the way that appears to me is that they should be the most important thing in my life because that's right there on the face of my phone. Now, texts have their place, but for most communication, which should be non-time sensitive communication, an email is better because I can conveniently check that when it's easy for me and I have access to a full keyboard. And that might sound like a strange thing or a little thing to bring up about not instant messaging people and making it convenient for you, the sender, even if you're blowing up your friend. This really helps preserve focus time.
Hmm.
And another thing I would say is what I do is I sort of batch and repurpose material, which is how I get so much media produced. So, for example, if I'm done recording a Get Rich Education podcast episode, I've got a lot of ideas flowing. I've got a lot of good energy. It brought energy to me to deliver that. And it's very easy for me when I'm all hot on these thoughts, say, for example, how inflation affects real estate investors. Once I'm done recording the podcast episode, it's very easy for me to stand up and shoot a video on this same material that I just delivered. And then finally, I might write a blog article on this same topic, for example, how inflation affects real estate investors. Now, there is a way to transcribe your podcast episode and get your spoken word put into written word, but for me, that doesn't really work. It's best to get up and write because the written word and the spoken word sound and appear rather different to a person consuming that. But that's what I do. I batch and I repurpose things based around thoughts. So again, I might record a podcast, get up and shoot a video, and then produce a blog article all based around a similar thought. I think that's how I get more done.
And is it safe to say that while you're in, let's say you're in the zone writing those
Yeah.
blogs, your phone is on silent? You're not taking phone calls from this guy, that guy. You're not answering quick text messages. You're in the
Right.
zone. And then you flick back on your phone and you return the 3 missed calls after you've done the writing or after you've finished the blog or after you've analyzed the spreadsheet on a potential deal.
Exactly. If you're responding to every instant message, you have just let others dictate your agenda rather than you taking control of your own. So it's about opening up that time and then filling it with focus time.
No, I'm actually with you on that a lot. Not everybody would agree with us, but I'm with you on that. You need to block out your own time to get things done. And if you respond to your phone every time it makes a noise, it's very hard to get anything done that day. You end up going home wondering, what did I get done today? So yeah, I'm with you on that. So I think, yeah, that's really good advice for investors who might be struggling to find time to source the deals. And I think the answer is like set your goals, spend time getting a team together, spend time looking at a market, and then turn off your phone while you find a property that matches all of those, and you'll go a very long way, and you'll still be able to sleep as much hours as you normally do. So yeah, I hear you. And look, one of the things you're known about, Keith, is that you have this great way of explaining how you can earn from real estate in 5 different ways, which I think surprises people, because if I ask that to most people that are buying from me, they'd scratch their heads to think of more than 3. So why don't you tell us, what are the 5 ways real estate investor can get paid from real estate?
Yeah, I'm known for talking about how real estate investors are paid 5 ways. And it took me a while to realize that I have 5 simultaneous profit centers as a real estate investor, especially when I put, for example, a small down payment on a Torcana property or with some other turnkey provider.
Mhm.
And you know what, Colin? We need to get into some numbers here. This is really the nitty gritty, but this is exciting because for the first time, you as a listener are going to find out all the ways that you're paid. And we're going to put an exact ROI number on that when we add up the 5 ways that you're paid. And now, if you think numbers are a little boring, you know what I tell people, Colin? Put a little dollar sign next to the number. It gets more interesting real fast.
Mm-hmm. Oh, and actually, you've got a great flyer on this, which I can include on the show notes, right? That I can where you explain this 5 ways on a 1-pager. I'll make sure to include that if you don't mind.
It's true. I'm glad you brought that up. I had an infographic made on the 5 ways you're paid. So with everything I explained here, you can see that backed up on the infographic. So numbers get more interesting when they're dollar signs, and they're not just dollar signs. We're talking about your dollars here. So real estate is what I call a 5-faceted investment class. So I think the most simple way to do this, Colin, is let's just briefly explore each of the 5 ways you're paid with a simple example. And we're going to talk about a $100,000 property just to make the numbers simple. And you
Mm-hmm.
put a $20,000 down payment on a $100,000 single family home where the rent income exceeds the expenses. And yes, you can find properties like this in the US Midwest and South. So that leaves you with an $80,000 loan after you've made your $20K down payment on your $100,000 single family home. And the property is already tenanted on the day you buy it, which is kind of the definition of turnkey, although the
Mm-hmm.
tenant might come in a few weeks later. So the first way you're paid, a 5, is with appreciation. Well, just say after the first year, this turnkey property that you bought appreciates in value from $100,000 up to $106,000. That is just commensurate with real estate's historic appreciation rate of 6%. And maybe you're thinking, oh, not very thrilling. But here's the thing, you got to listen closely. Your $6,000 gain is based on your down payment of only $20,000. That's your ROI formula, a 6K gain divided by 20K of skin you've put into the game. And that magic of leverage means your return is 30%. And now your leverage light bulb starts to go on when you realize, well, wait, how did my 6% gain go to a 30% gain? That's because you got 6% of appreciation on both your $20,000 down payment and the $80,000 that you borrowed from the bank. That 80K borrowed from the bank, the gain that was made on that, that goes to you, not the bank. This is also why I say the compound interest is lame. Leverage is what builds wealth. The second of 5 ways you're paid is with cash flow. Let's just say that your property's rent income minus all of the monthly property expenses, the mortgage principal and interest, vacancy, maintenance, taxes, utilities, management. Just say that only leaves you with $150 of residual income at the end of each month. That's $1,800 annually divided by your 20K down payment again. That is another 9% return to you. This is the portion known as your cash on cash return. So just to summarize, we have 30% of a gain from appreciation plus 9% from cash flow. We're up to 39%. And now to talk about the third of our 5 ways is loan pay down. Your tenant makes principal pay down for you on your property. Now you might think you already have this advantage if you own your own home, but you don't, because you're in your own home. When part of your mortgage payment goes toward principal and interest, all of that money, including the principal pay down, came from money that you had to earn. But in your rental, the tenant earns the income that pays down your principal and interest. Now, you're going to have to believe me. If you just look at an amortization table at a 6% interest rate on a 30-year mortgage, that's $898 that the tenant pays down for you annually. Divide that by your 20K of skin in the game again. That means it's another return for you of 4%. The fourth of 5 ways you're paid is with tax benefits. Now, this gets hazy, and I don't want to get too far off course here, but we're talking about benefits like depreciation that you can typically use as a tax write-off against your rent income and the aforementioned 1031 tax-deferred exchange. We're just going to call this tax benefit 5%. I know when I have Rich Dad Advisor Tom Wheelwright come on my show and talk with me, he would say 5% is too small with something that Trump gave us called bonus depreciation, but we're just going to keep it simple and conservative here. Mm-hmm. And then the fifth and final way you're paid, this is one that even advanced investors fail to consider. Now, look, Colin, you're a smart investor. Like, you wouldn't keep $1 million in the bank over a long period of time because you know that a 3% inflation rate, after a year, your purchasing power would be down to $970K, and after a second year, your purchasing power would be down to $940K. But look, just like inflation would erode the value of your lump of savings, it also erodes the weight of the $80,000 mortgage debt balance that you have on this turnkey property just the same. So your $80K loan in today's dollars, it has its drag diluted over time as more and more dollars circulate in an economy. It gets easier to pay back with depreciated dollars over time because wages and prices become higher. And remember, the tenant pays the interest on this. All the interest is outsourced to them. So this effect gives you another 3% return, which is about the true rate of inflation. It's higher than the CPI that the government reports. So if we add up all 5 ways you're paid, appreciation 30%, 9% from cash flow, 4% from loan pay down, a tax benefit of 5%, your inflation profiting benefit of 3%, you come up with a year one return of a whopping 51%. And we did not do anything high flying or speculative here. This is just buy and hold real estate. This is exactly why real estate has made more ordinary people wealthy than anything else. If you can grasp and understand that right there, that seems ridiculous to you. If you come from the consumer credit world, it sounds like you're making some inordinate, ridiculous risk. But gosh, I think you know, Colin, that there in Tampa, for example, the appreciation rate's been even higher than the 6% that I just gave you. So
oh, yeah.
It
which would
really is.
magnify all those numbers accordingly as well. It's
Exactly,
incredible.
since you're leveraged. And let's just notice a couple limitations here. About the example I gave, I did not factor in your buyer mortgage loan closing costs. Sometimes that's something the seller can help you pay for. And if you buy a property in a losing job market, or you hire the wrong property manager, like that lack of strategy that I was talking about before, your
Hmm.
entire investment could go south. But you've got room for error here with a 51% rate of return. Even if one third of things went wrong, I think most people would be happy with a 34% return.
No, you're right. I mean, too many people might just look at their rental income, 150 a month, and they decide, yeah, 150 a month isn't a lot for a $100,000 property. But like you say, they're not really looking at all their numbers. They're not looking at, and it's the same if you're comparing a market that's appreciating by 6% with one that's appreciating by 1%. That 1% market won't be anywhere near the 51% you'll get in a market that's appreciating by 6% a year. So that is a very nice way of explaining it, Keith, and I'm going to include that infographic in the show notes, because it is you explained it really well, but it's also very nice just to look at it and print it out and
Yeah.
just pin it up in your home office and look at it anytime you're worried about real estate and worried about investing in real estate. I think it's very helpful.
Well, I'm glad you brought up that point about a lot of people just look at, in this case, the $150 of cash flow. And maybe you had something happen to you as an investor, like, oh, I had to replace a fence section. It cost $600. That wiped out 4 months of my cash flow. Well, when you realize all the profit centers that you have, it can make events like that just seem a lot more digestible to you. And this is so important because we're talking about keeping score here. When you know how to keep score as an investor, now you know what to buy, now you know what to sell, now you know when to sell, now you know when to do a cash out refinance or a 1031 exchange. Keeping score is important. Some people think that they're winning at real estate investing when they're really losing, and
Mhm.
some people are really winning when they think that they're losing. So now you know how to keep score.
I couldn't agree more. Look, we're going to wrap up soon, Keith. I know your time is very valuable, but you've been around the block. You've spoken to a lot of people. You've invested in a lot of real estate over the years. Have you any funny stories you can tell us from your real estate investing career? Anything you'd like to share with us?
Yeah, I sure have done dumb stuff in the past, and I'm not immune from doing it in the future either. When I bought that first ever fourplex, I had a vacancy one time, and it was the summertime, and I don't want to keep showing the unit to tenants, prospective tenants, over and over again. It just takes so much of my time. I just want it all to be over with. Well, one of the first group of people that looked at this vacant unit I had, which was the unit right next to mine in the owner occupied fourplex, three girls looked at it and they were extremely attractive. And I thought, oh my gosh, if they can live right next door to me, I don't care what their credit score is. They're probably going to get a job. Someone's going to want to hire them when they look like that. So, not that I would ever think this way anymore, of course. This was back then, but it did not work out. They tried to hide a dog on me. I mean, pets weren't allowed. And how dumb is that? They live in the unit next door, and they partied so hard that the police had to show up twice. So,
Oof.
um, don't hire based on looks.
I hear you. I don't blame you for falling for it as a
Not
young
the best
investor
way.
either. I can imagine a lot of people doing exactly the same thing when presented with the temptation. So, fair enough. Thank you very much for sharing that. But look, we're going to wrap up now, Keith. This has been a great show. Thank you. I mean, how can our audience learn a little bit more about you if they want to, subscribe to their show or look at your website? What's the best way to get in touch?
GetRichEducation.com, and the Get Rich Education podcast is where I've made the show that I would have wanted to hear back before I even knew how real estate investing made ordinary people wealthy. The podcast has had so much more reach and success than I ever would have thought, with more than 2 million downloads, and we really attract some high-end guests there, like Robert Kiyosaki and Jim Rogers, and the inventor of the 401k. So I'd be grateful to have you listen in over there. Again, it's GetRichEducation.com and the Get Rich Education podcast.
Okay. Thank you very much, Keith. It's been a pleasure speaking with you. Happy Christmas, and let's stay in touch.
Colin, talking about this stuff fires me up. Thanks so much for having me. Happy holidays.
So there you go, folks. That was podcast number 30. I hope you enjoyed it. I thought that was a really good show. I think we covered a lot of interesting ground there, and certainly Keith provided plenty of food for thought as we head into the final weeks of 2018. Keith, he's just such a thoughtful guy. You can tell he really spends a lot of time thinking, analyzing the important pieces of the real estate market, and the way he breaks it down and provides actionable insights for his listeners is quite rare. I think he's just going to get more and more successful as time goes on. He's already done amazingly well, and he's got a very big profile already. So if I could summarize 3 takeaways from this show, they would be: number one, never underestimate the importance of goal setting and aligning your actions and habits around those goals. I mean, put the property further down the chain. So it's just so easy to get distracted. But we learn again and again and again that if you want to be successful in anything, you need discipline and focus and goals. So try and do that. Try and take some time to do that first before you just dive into looking at all these different houses and crunching the numbers. And I'm guilty of it as well sometimes, to be honest with you. So, I'm going to learn from that as well. Number two, when you're analyzing and comparing deals, I think it would be super useful to think of them in terms of the 5 ways you get paid. So that would be appreciation, cash flow, loan pay down, tax benefits, and inflation hedges. Most of us just look at 1 or 2 of those. So I've put a download link in the show notes to Keith's infographic highlighting those 5 ways you get paid. And go ahead and download that, print it out, stick it on your desk. I think it'll be very useful. Number 3 is, just don't sit on the sidelines. If you want to build wealth, you need to create a path, build a team, take action, and just gain some experience, make some mistakes. And like Keith said, the key to have, is to have your money, the tenant's money, and the bank's money all creating wealth and income streams for you. That's how it's done. So, there you go. That's it for today. I think if you like these shows and you have a minute to show your support, I'd be very grateful if you could leave me a quick review or 4 or 5 star rating on iTunes or SoundCloud or whatever platform you're listening on. That would be super useful. It'll raise the profile of the show, and I'd really like it. But look, I'll sign off now, and as this will be the last show of 2018, I'd like to wish you all a happy Christmas, a Merry New Year, and let's all raise a toast to a successful 2019. This is Colin Murphy signing out. This recording contains general information relating to the real estate market, and it is for educational purposes only. Buyers should always seek appropriate legal, tax, and financial advice from suitably qualified professionals before entering into any real estate transaction. Actual returns from rental properties will always vary from person to person and deal to deal based on unique circumstances. While we have no reason to doubt the validity of comments of any guests on our show, we do not warrant their accuracy. Opinions of the host are not necessarily shared by other employees and partners of Torcana and its subsidiaries.